My experience with Alpha so far has been nothing short of exemplary.
The word that would best describe them, I think, would be trustworthy.
They're just a fantastic group of people.
We have a fantastic team in Alpha Wealth. We're all fully qualified individuals with over 60 years of combined experience between us.
I've spoken to so many different people that they feel like they've just like an extra cousin I've never met before, and they're always there with a kind of a helping hand to do whatever I need.
They have a very professional approach, and you feel like you're getting advice that you can trust and rely on.
They're a company that I would definitely recommend to friends and family. Nick and the team are there at the end of a phone or at the end of an email, and they will always come back to you.
Alpha Wealth provide a full range service to our clients' needs, just to make sure that you're doing the right things for you and getting the most from your own money, getting it working harder for you and ensuring that your family are protected.
Good evening, everyone. Thank you very much for joining this webinar this evening. For those of you listening live, my name is Nick Charlambus and I'm the Managing Director of Alpha Wealth, and I'm joined by Shane Connole, who leads Munster Mortgages, who are based in Cork alongside ourselves. I'm conscious it's Pancake Tuesday today, not Thursday, as it says there on the slide, so apologies for that. We had intended originally of doing this particular session on the Thursday. But what we're going to do is we're going to spend the next 25 minutes or so just helping anybody who has a mortgage or indeed is looking to get a mortgage in terms of lining yourselves up to how to best manage that. Shane is an expert in this field. Alpha Wealth have no specific affiliation to Shane apart from the fact that we feel that he is the best person in this area. And I would encourage people to listen to Shane. I find him to be very, very knowledgeable in this field. And what we're going to do this evening, guys, is I'm joined by two of my colleagues, Clean O'Donoghue, who's our Director of Business Development, and also Shane Connole, who's our Head of Marketing. And we're just going to try and make this as interactive as possible. And please do feel free to put any questions that you have into the chat function, the Q&A function even. We would like to make sure that we address them. We have received quite a number of questions which Clean is going to kind of go through during the course of this session, but please do feel free to ask any questions, and we will endeavour to get those done this evening, and if not, we will get back to you, obviously, and we will provide you our contact details. This is going to be finished exactly in 28 minutes, so I'm very conscious the fact that it is Pancake Tuesday, and I understand that there is a Champions League game for all the Liverpool fans that are out there, so I'm just going to go straight into it. For those of you that are not familiar with Alpha Wealth, we're a Cork-centric company. We do have a small presence in Dublin. We have 1 or 2 staff based there, and we provide independent financial advice to individuals in all areas. We do give guidance on mortgages in terms of general advice, but obviously we do use the services of Shane for specific advice, and certainly Shane does provide mortgages directly as an independent mortgage broker. So the two things really that we're hoping that you can get from today is helping people who are looking to buy a new house or indeed are looking to upgrade or move or buy a second property in the near or distant future. And I would refer to the next 5 years really, and how to best fund for a deposit for a property. And then secondly, how to get a mortgage or navigate the current mortgage that you have. There's obviously been a massive increase in interest rates. We've seen the ECB rate go up to 3% over the course of the last 4 or 5 months. I think it's really, really pertinent for people to make sure that they are looking and addressing their current mortgage situation. Obviously, there's some recent press. I've just put down a few of the recent press cut-ins, and I think we're all familiar with how the mortgage market has changed so much, having been so, I suppose, stagnant in terms of interest rates for so many years. And essentially what I want to do now, as I say, is just give you a kind of a broad sense for anyone who is starting out on that sort of deposit journey, how you might best navigate that. And really what I'd like to do is just compartmentalize that into sort of 2 time zones. One is short term. So anyone who is looking to buy a property in the next 3 years, my advice is to just do that through a bank, credit union or post office, and set up a proper savings vehicle and make sure that you build up the necessary deposit that's required. And Shane will allude to this later. However, if you're looking at building a deposit up over 3, 4, 5 years plus, there are options other than the banks that I feel are more appropriate where you can earn interest and get a better return for your money. The starting point really that we suggest that all people would look at, and I'd suggest this for everybody, whether you have a mortgage, looking to get a mortgage, or have absolutely no interest in mortgages, and it's really using a financial budgeter, which is a tool that we encourage people to use at least once a year. It takes about 10 minutes. It's available on our website. Keenan can pop that into the chat for anyone who would like to use this. And I'd suggest that it's a really powerful way of seeing what you earn and how you spend your money, and making sure that you are taking advantage of opportunities. And use a financial broker. Obviously, we're offering the services of Shane, who's obviously a mortgage broker, and making sure that you're reducing all costs in various different areas, not just in mortgages, but also things like insurances, savings plans in terms of costs, pensions, and so on. And that's something that we do for our clients. Just briefly before I kind of bring Shane into this, just to mention that I said earlier about 3-4 year savings. And the example I want to use is that, let's say you're looking to buy a property of 300,000 plus over the next 4 years. That would require 30,000 euros deposit. The example on the screen there shows that if you can earn interest of 3.5% approximately, you would need to save about 570 a month over that period. If you happen to have a lump sum, 8,000, it would require a lesser amount of 400 euros, again, assuming that interest rate, which you won't get in obviously the bank, post office, or credit union. There are accounts available. We offer them as an independent broker. This is one through Zurich, who are our preferred provider, that give the potential for growth of 5% a year or more, with no exit penalties, very flexible. And I do feel that they're a really good, appropriate vehicle to use, as I say, for anyone who is looking to use this. And it's not just for mortgages, by the way, it can be used for other purposes such as children's savings and so on. So I suppose I'd like to introduce Shane now, and just to get into, I suppose, the area of specifically going about getting the mortgage.
So Nick, maybe I'll just hop in one question there for you, Shane. So for anyone that's looking for a mortgage in the next 12 months, what steps should they be taking now to ensure first-time approval?
I think, Leon, hello everybody, first of all. Good evening on Pancake Tuesday, as Nick said. I would think that the main thing here is to make sure that you've got your ducks in a row. So again, we've outlined this before, but if you come to a lender in a scenario where you're badly prepared and you end up in a situation where you get a defer response or a decline response, it's very hard to overturn that within a 6-month period. So we would say to everybody is to give your file or your proposal the absolute best chance from day one to receive an approval in principle, so that you can go out into the market with confidence. Certainly the thing to avoid here is to get that defer response or a decline response where you're going to be coming from behind a black ball when you come in 6 months' time, when the lender says we'll defer you for 6 months. So one shot only, really, get it right first time, and that gives you the best chance of you getting a successful approval in principle.
So another question that came in advance was, we are first-time buyers and thinking of applying for a mortgage in the next few months. We are thinking of availing of a Help to Buy scheme as the first option, but we would like to keep our options open at the same time. We don't mind buying an older house and renovating it ourselves. Can you provide some advice on what the best options are for us?
Okay, so Help to Buy number one is a fabulous incentive that's from the government, from the revenue more so than the government. It's a tax rebate on income you've paid cumulatively over the last 4 years. A couple of key conditions on it is that the house price is capped at 500,000. The amount is capped at 30,000 as long as you have paid that level of tax over the last 4 years. You have to be borrowing more than 70% of the value of the property. And the key one is that it has to be a new house. So all very fantastic as long as you can meet those 4 criteria. The only catch in it is that you have to stay in the house for 7 years. If you were to leave the house within the 7 years, the full Help to Buy that you received has to be returned to the revenue. The next scheme worth talking about is the First Home Scheme, which is a very new scheme in Ireland at the moment. Again, it helps with the deposit. A fantastic scheme for 5 years, but anybody who's looking into it and does a bit of research on it needs to be very careful as to what happens after 5 years. This is the scheme where essentially there's a share given to your property equity, and any increase in your property equity, there is a third party receiving a benefit out of that. So again, the first 5 years where the deposit income given to you, or the deposit amount given to you by the state, is tax-free, or sorry, interest-free, you do end up in a scenario where you're then going to end up paying for that pleasure over the remaining period of the loan. So again, something to be very careful of. To answer the question that was asked about, can we move within properties? If you're buying a new property and you're approved for the Help to Buy and you end up buying an existing property, there is no change in status whatsoever. You just simply cannot use the Help to Buy.
Okay, perfect. Are any banks still doing cashback offers, and who has the lowest rates in the country currently?
Right, well, in terms of rates, we'll answer the rate one first. In terms of rates, every lender is the best at some particular rate segment. But if you were to look at the better rates in the market at the moment, you would probably see Bank of Ireland with a nice rate of 3.2 fixed for 4 years, PTSB with a nice rate of 3.3 fixed for 5 years. Both of them come with caveats. He's got to be a green rate of property and the loan has got to be over 250,000. But if you were asking for where's the rate set in the market at the moment, the rate is generally set somewhere either side of 3.5% to fix for somewhere either side of 5 years. There are 5-year fixed rates available in the market from some providers at 5.5%. They're to be steered well clear of. So again, you look at the cashbacks that are on offer then, or incentives in general that are on offer. We have 6 lenders in the market at the moment. We would certainly suggest to people that ICS Mortgages and Finance Ireland have priced themselves out of the market, not really under consideration. You're then left with Avant Money, AIB Group, which makes up AIB, EBS and Haven Mortgages. You have Bank of Ireland, you have PTSB. Avant Money are very attractive on rate, but they carry no incentive. The incentives that are carried in the marketplace at the moment are Haven Mortgages would give you a €5,000 incentive as long as your loan is over 250,000. PTSB will give you a 2% initial cashback, initial being that it gets paid to you within 8 weeks of your drawdown. So if you were to borrow 300,000 as an example, you're getting 6 grand back from PTSB within 8 weeks. PTSB also offer another incentive for the next 4 years if one of you bank with them, where they'll give you a 2% deduction in your monthly repayment. The best incentive that's available in the marketplace today is the Bank of Ireland cashback incentive. So same as PTSB, 2% initial cashback up front after 8 weeks. If one party banks with Bank of Ireland, there's an additional 1% payable after 5 years. So if you were to fall into that category of Bank of Ireland, you have a 3% cashback facility coming towards it.
And given the recent rate interest to 3% ECB and all banks increased rates, what is the best 5 and 10-year rate I can fix for?
Well, we think your best 5-year rate, what we're looking at the moment, again, depends on the category, whether you have a green rate of property or you're over your 250,000, 3.5% generally. But if you have a green value rate on it, it's 3.2. Now, to give an example in some of the incentives, which is important for people to be aware of as well, when you get the better rates with the lenders, they do not carry the incentive that goes with them. So for example, if you go to Bank of Ireland and you say, I have a high value product, they do not carry any cash back with that. Their standard products or their green rated products do carry that. So there's a price to be paid in your rate offering for selecting a cashback product. But to be fair, clean on it, if you're to do the maths on this in any shape or form, the cashback is tending to win out in every example. But important for people to know that you can't get the better rate plus get the cash back as well.
And for anybody that has a current mortgage at the moment, a tracker, is it worth considering moving off that tracker and onto a fixed rate?
It very much depends on the margin of your tracker. So the margin being what you track the ECB rate by. Historically, for the last 5 years, that rate was 0. So if you were on a 1% tracker, your rate was 1%, whilst the rest of the market was somewhere around 3%. Obviously, a lot has happened in the rate market since last July. The ECB is now 3%. So if you had a 1% tracker, you're paying 4% of repayment. Very hard that for you to say there's any merit in you moving away from your tracker if your margin is under 1.5%. But you do have to be, I suppose, aware that there's a very good chance that that 4% rate that you're currently on is going to be 5% at some stage, but that will start to come down fairly quickly once the ECB move down. And again, pie in the sky, you have the inflation issue with that, and you have the Ukraine issue as to when that period is going to be.
Just to mention, sorry to jump in, but if anyone does want to ask any questions, please do feel free to put them into the Q&A. As I said earlier, we just want to make this as, I suppose, interactive as we can. And whilst we did get quite a number of questions, obviously, before the webinar, if anyone does want to ask anything, you can ask it anonymously, or indeed just throw it into the Q&A. And obviously, we will endeavour to try and cover it off. But sorry to interrupt, Cleena.
Cleena, could we just answer item 3 there on the slide, if you don't mind, the repayment capacity?
Absolutely.
Just for listeners here today, a key component of you getting approved for your mortgage is that regardless of how your income stacks up, you need to be able to demonstrate to the lender your repayment capacity. Now, I'm sure people are online and looking online. It's called demonstrated repayment capacity. It's called proven repayment ability. It's called lots of different things. But essentially what it is that if you ask a bank for 200,000 as an example, and let's just say the 200,000 costs you €1,000 a month, you have to be able to prove to the bank from your most recent 6 months of record that you can put away that €1,000. If you cannot demonstrate that repayment capacity of €1,000, then you're not getting approved for the 200,000. How is repayment capacity demonstrated? Generally, it's done by rent, as long as the rent is paid via the bank account, rent or a savings record.
Thanks for clarifying that, Shane. So this is for somebody building. If you're building and have some money, say for the site, will the bank lend to you for some of the site price before or after you have planning? Also, will they only approve you for the final cost of the build rather than site part first, let's say? I know that's kind of a two-part question.
All right, okay. So the easy one first is planning permission. So if you go to any lender in the country, and this is going on for many years, but if you go to any lender in the country without planning permission, there is no lender talking to. So you must have planning permission to be able to approach a lender to get an approval. The second aspect of the question is that on the site. So if you're purchasing a site and that site has planning, a lender can allow up to 80% of the value of the site to be drawn down by way of their mortgage. Again, planning permission has to be in play, including final grant of planning and a maximum of 80%. Some lenders are 75%, but you can get 80%. I suppose the thing worth pointing out, Cleena, for people is that when you talk about 6 lenders in the marketplace at the moment, there's only 3 lenders do self-build mortgages, which are Bank of Ireland, PTSB and AIB. So somebody might say, we hear Avant Money are great, and yes, they are great, and yes, their rates are great, but they don't do self-build mortgages. So in a self-build scenario, you are limited to Bank of Ireland, AIB Group and PTSB. And
is there any particular reason for that, Shane?
I would imagine it's an awful chore for a lender to have a stage payment mortgage. It goes on and on and on. There's many touches to the case. Your systems have to be set up for it. And I would say that Avant, ICS and Finance Ireland just don't have systems that can take it. Probably on purpose straying away from it and blaming their system.
Okay. A question has come in in the Q&A. What are the current application processing times for switching?
Oh, depending on lender. Avant Money as an example, processing time to AIP is probably 24 hours. Loan offer is probably a week, and funding is probably 3 days. That's the extreme end of the scale. What I can also tell you is that Avant Money, to do that process last summer, were taking 4 months. So the switcher market has dropped away significantly because of the rate cycle that we're in. Avant would be known as a switcher lender, so generally they're not attracting as much business, therefore they have the time and their systems aren't under pressure to turn it around as quick as that. If you go to the opposite end of the market and you say go to a Bank of Ireland, PTSB, AIB scenario, I'd probably tell you need 2 months to make it all happen, and there's a chance that you'll touch 3 months.
Okay. And in terms of, we're going back to the calculating repayment capacity here in this question. So if we have one child, age 7, and we are renting, and I'm working on a part-time basis, my partner is doing full-time, how would you suggest that we calculate our repayment capacity?
Can I look at that one? Can I look at that one? 1 sec.
Yeah, I mean, they've also said that if they need, if they need to provide more info, I suppose it's kind of what information do they require?
Right. Okay. So the information that's required for that is your child age 7, not an issue. You're renting, not an issue. Part-time basis, as long as it's permanent part-time and you have a track record of greater than 12 months of it, not an issue. Your partner's obviously doing full-time, so that's fine. So where you'll be looking at here is that whatever you're renting for, as long as you're paying that via the bank account, that goes towards your repayment capacity and any other regular savings pattern that you have in the background. That could be standard saving, it could be saving inside the current account, it could be an alpha wealth policy type thing. So as long as you can add something to that rental figure, that's fine. Now, if you have no savings, but you're being charged excessive rent, that rent may also cater for the full repayment capacity that you require.
Okay. And do all banks take shift allowance into account if it is part of your working week, which is the case with the HSE?
Yes, but with a track record. So if you were to make an application for any mortgage, you'd be given a document, what's known as a salary cert. Salary cert is for your employer, your HR to complete. The bank essentially here is looking for a box to be ticked that says the shift allowance is guaranteed. If the box comes back with the shift allowance ticked as guaranteed, that will get the four times income multiplier in it. If it comes back with it ticked as regular, which is more to the point that usually happens, then the bank is looking for a track record over the last 2 years of what level of shift allowance was received. If you go on to the other side of the question, what you'd often see is you see people working in the pharma industry, and in the pharma industry, the shift allowance is a de facto part of their contract. That is all that comes back as guaranteed. But I would say with the HSE, you'll generally see the HSE come along and say they'll tick the boxes regular or irregular rather than guaranteed. But if they tick it guaranteed, it'll be fully taken into account.
And for anyone looking for a mortgage this year, would you suggest that they maybe wait for the rates to come down and property prices to come down, or do you have any thoughts on this? Or is it about how long is a piece of string?
Thoughts are dangerous. Thoughts are dangerous in this, right? So is it a good time to buy a property? It would be wrong of us to say it is. Was it a better time last year to buy a property? Probably similar. The time to buy a property was 5 years ago, but we're not 5 years ago. We are where we are today. The one thing that I think every economic commentator out there will tell you is that we're still in a situation where there is more demand than supply. And as long as there's more demand than supply, you're going to see a property price market aging. And I suppose one of the things that people should be aware of is that we've been doing webinars over years, and obviously clients over years and things like this, but we've had clients 4 years ago thought it was a bad time to buy and sat on the fence. And those clients are now coming to the market because they're just fed up of renting and paying dead money in rent. And they're finding that the house that they could have bought 4 years ago is now 50 grand dearer. So you've got to be very careful about sitting on the fence. Now, in terms of the rates, Cliona, it's a very hard call because it's very much driven by the inflation issue. The inflation issue is driven by two other drivers, which was coming out of COVID, not necessarily COVID, the medical condition, but COVID that stopped industry. So you have the COVID issue that's feeding into the inflation, you have the Ukraine feeding into the inflation. And none of us are able to say that any of that is going to go away anytime soon. But once that does start to go away, you might then see a scenario where there will be a plateauing of rates, and you may generally find out that rates start to come down. But I don't think we're going to see rates come down as fast as they've gone up. So currently at the moment, you're looking at fixed rates somewhere around 3.5%, 4%. You're looking at variable rates somewhere around 3.5% at the moment, but you're looking at ECB tracker rates at a minimum of 3, with another 0.5% rate rise coming next month, and more than likely another one coming in May as well.
Yeah, not fun times.
No, but let's tell the truth.
No, absolutely. In terms of repayment capabilities, for somebody, let's say, that's renting and is paying utility bills, and we all know that utility bills are very high at the moment, would these be taken into consideration with those repayment capabilities when you're calculating?
No, they actually wouldn't. And the reason that there's a bit of sense to this, the reason being is that if you're paying utilities at the moment in your rental accommodation, and you were to leave your rental accommodation and find a house of your own, you still have utilities. So any lender is going to say to you, look, you know, you might have had 200 euros in bills in a rental accommodation, but when you buy your own house, you're still going to have that 200 euros in bills. So that's why they would not be taken into it. So again, if I can just run through it, because it is a very key point, and I'd be delighted if people got out of this. This is a very, very important point in you getting approved. The areas are my rental record, my savings record, be it in your current account or be it in a policy or be it in a standard savings account. And the other one is loan repayments that may not be there when you have the mortgage. So for example, if you had a personal loan where you were paying 300 euros a month, but that loan is about to finish, that 300 euros a month can be added into your repayment capacity to be able to demonstrate it.
Okay, I think that's great, Shane. It gives clarity on that issue. So we're going to move on to talk maybe a little bit and give a bit of information for people that are self-employed on the call. What is required in terms of documentation, and maybe how does the mortgage application vary from somebody who is a PAYE employee?
Right. Okay. So a PAYE employee has to put together a file that may have 100 documents on it. If you're self-employed, you can be prepared to put 200 documents on it. So far easier being in a PAYE capacity. If you're in a self-employed capacity, you have to do everything the PAYE has to do in terms of your personal information. 6 months of this, 6 months of savings, 6 months of borrowing, 6 months of credit cards, Revoluts, all these type of things. The key difference here is that a self-employed person needs to provide a salary cert from their employer that we mentioned earlier, needs to provide an EDS, which is the new style P60, and needs to generally provide 3 months worth of pay slips. If you're in a self-employed capacity, you need a minimum of 2 years of annual accounts, a minimum of 2 years of revenue approved Form 11s and Chapter 4s, which is your revenue assessments, 6 months business bank statements, tax clearance, and confirmation for your accountant that all your tax affairs are in order. The big thing for the self-employed client is the 2-year thing. So you have a number of lenders that will average you over 3 years. Some lenders will average you over 2 years. But what's an absolute non-runner here is somebody saying, I left my employment, I started up a business a year ago. There is no lender going to touch that until there's 2 years worth of books that they can average.
So this may answer the next question that's come in, Shane. It says that my husband has a very successful new business, 18 months old and linked to Amazon, so very stable. We've been paying 2,200 in rent per month for 3.5 years, yet we can't find financing to buy a house. I work as a teacher and we have 100,000 as cash deposit. So would it be the less than 2 years that is affecting, I suppose, any mortgage approval here?
It generally would, unless they, and again, we're not sure on the actual chat there on the links to Amazon, but unless there was a specific contract held with Amazon, and that contract was of a sustainable length of somewhere around 24 months or greater, that's the only angle that I would see there for somebody to be able to say, I'm not 24 months in business, but I have a very strong contract that may be for a period of 24 months. That is certainly an angle on it. And maybe if I might answer that by answering a separate question, is that if you look at the pharma industry, which is famous for the contracts, you'd have an awful lot of people would leave their employment with the Pfizer, but come back in the back door via one of the umbrella companies as a self-employed contractor. If you were a sole self-employed contractor, there are lenders that will base you on 1 year's worth of books as long as you were a sole contractor. And a sole contractor means I have a contract with one company. Whereas if you're in a self-employed business and you said, I've got 10 different contracts around the place, that's not deemed the sole contractor. So it can be done. And if that lady would like to, I suppose, say, develop a bit further what the linking to Amazon is, certainly we'd have a look at that for them.
Okay, perfect. And you'll provide contact details. We can provide them to everybody that's on the call.
That's fine. Yeah.
So if I'm paying rent and transferring to landlord's bank account, but he is not registered with the RTB, can this still be taken into account when applying for a mortgage?
Absolutely can. No issue at all with that. What I'd like to know on that one, or what you could do with making that slightly better for yourself, is making sure that what is that called when it leaves your bank account. So ideally, it's just called rent, or it's called the address of the property, or it could be called a landlord's name, but no issue at all with that he's not registered with the RTB. And again, to potentially answer the next question that may come, the only rental situation which is a problem is where you pay it in cash. And cash means I took 800 out of my bank account and nobody can trail that back anywhere towards a rental repayment. So even if you were doing that, just make sure you call the payment out calling rent. So again, you go to a bank or you go online and say, I want to take 800 euros out and take it out in cash. You do have an opportunity to call that something, call it rent.
Okay. In terms of insurances, and Nick, I think I might move on to you, give Shane a little break here for 2 minutes. What insurances will somebody need when they get mortgage approval?
The two main insurances that basically anyone taking out a mortgage or moving a mortgage needs is the life assurance, which is mortgage protection. There's sometimes a little bit of confusion as to what exactly is required. And officially, and Shane can, I suppose, attest to this, is you only need the life assurance on your private residence. The banks may ask for mortgage protection on an investment property, and it may be a condition of the loan, but legally speaking, it is a requirement for your private dwelling, your own house that you live in. That's a product that we can provide. I would suggest to everybody who has a mortgage, or indeed if you're embarking on a mortgage, just make sure whoever you use, whether it's Alpha Wealth or any other brokerage, that you pay the cheapest cost you can. My experience in the life industry has been that many people basically pay too much for their mortgage protection cover. And the rule of thumb that I use is typically if you're borrowing 250,000, 300,000, and you're in your sort of 30s and 40s, you really shouldn't be paying a lot more than 20, 25 euros a month for mortgage protection cover. Some of the financial brokers try and add in things like serious illness cover and income protection. And whilst these are relevant financial products, I do think that they should be kept separate to what you give to the bank for that. The second insurance that you require, again, as part of a stipulation, this is something that Shane can assist people with, is house insurance, which is basically, providing for the cost of rebuild. And again, as an independent broker, we help clients find the lowest cost. It's not a product that we provide. Just to finish up briefly, guys, and I'm conscious it is 8 o'clock, and I did say we'd have a hard finish after half an hour. And I do appreciate all the questions, and thank you for taking the time this evening. As you can see, Shane is a wealth of knowledge, and Shane has a fantastic business and has helped our clients navigating this kind of, I suppose, area of mortgages. I appreciate one of the attendees has asked to contact Shane, and we will provide everyone who is on the call both Shane and our contact details. And please do feel free to reach out to Shane and indeed Alpha Wealth. We would like to talk to you. We're happy to advise you, and there's no cost of the initial advice. So do reach out to us. Alpha Wealth provide a full financial consultation, which does encapsulate a lot of other areas, and that's a separate thing, which is 99 euros. It's discounted for anyone who is on this call. But really, the purpose of this evening was to help you, I suppose, understand the mortgage market. Obviously, I appreciate Shane's time in doing this evening. And for anyone who is listening on playback, please do feel free to reach out to us and to get more specific information or advice. And Shane is very amenable. As I said, if people have questions, please do ask them. But I am conscious, I did say that we would say, and I appreciate there's a question there, is there a cost to speak to Shane? Shane, do you want to take that maybe as a final question?
Sorry, no, there's not. Not at all, no.
Okay, great. And I suppose, guys, again, don't be apprehensive about reaching out. As I said, I've dealt with Shane over many years. We're not trying to catch anybody. We are trying to give, proper advice to people in the way that, Shane and myself are enumerated. It's if you conduct business. So if you take out a mortgage and you do it with Shane through all of the institution that Shane obviously is regulated throughout the Irish marketplace, Shane will get you the best mortgage possible, and it's the institutions that will pay Shane. It doesn't cost you additionally, and it's the same in the way that Alpha Wealth typically operates. So just to be mindful of that. Thank you very much for your time this evening. Thank you, Kleena, and thank you, Keenan, for managing that. We will send out a copy of the slides to everyone who was in attendance and the video. I appreciate some people did arrive maybe a little bit later. We will be doing more webinars during the year, so please do look out for them on our website, Alpha Wealth. And thank you very much again, and enjoy the rest of Pancake Tuesday. And we look forward to sort of speaking to you in the near future. Thank you.
All right.